Hello, this is Group 15, and today we are going to focus on trading agent. So in the early days of quantitative finance, portfolio optimization was built on linear theories, such as the microwave's mean variance model and risk parity. These models offer elegant mathematical structures but rely entirely on historical correlations and linear constraints. When one asset performed well in the sample period, the optimizer often over-allocated to it, which made diversification a manual adjustment rather than an emergent outcome. Later, the industry moved to factor models, machine learning, and deep neural networks. These methods greatly improved short-term prediction and supported the rise of algorithmic and high-frequency trading. However, they also turned investing into a purely mathematical exercise. Many of these models are opaque, lack interpretability, and tend to fail when the market experiences structural changes or black swan events. Our project explores a different path. We use large language models organized as a multi-agent system to replicate the decision-making process of a real hedge fund. Each agent has a distinct function: fundamental analysis, sentiment, news, technical analysis, research synthesis, trading, risk assessment, and final portfolio management. We tested this system on Google and Amazon over a 3-month period from August to October 2025. This time frame captures key market events and provides a rich environment for analysis. Our objective is to build a decision workflow that is transparent, interpretable, and adaptive, bridging financial reasoning and LLM-based collaboration. The LLM workflow process began with a data input, include price and volume data, financial statements, real-time news, and sentiment indicators collected from open sources. These data streams form the foundation for analysis. Then our system contained 8 specialized agents, each simulating a role commonly found in the hedge fund decision-making. The first 4 belong to the analysis layer. The fundamental analyst evaluates company value based on the financial statements. The technical analyst focuses on short-term market patterns and momentum indicators. The news analyst summarizes major new events, while the sentiment analyst measures investor tone using sentiment analysis. The reports are passed to the research and decision layer. The researcher team then combines all these findings into a single comprehensive research report, where a bullish and bearish researcher critically review and debate these analyses. The trader agent then formulates a trading plan that balances both views. This plan is examined by the risk management agent, who assesses portfolio exposure and market volatility before it is sent to the fund manager agent for final approval. The output is a structured trading decision: buy, hold, or sell, along with a textual explanation summarizing the reasoning chain. This workflow allows the model to behave like a miniature hedge fund. To build our system, we first need to give our agents data. These slides shows 4 key data streams that feed our analyst team. First, the fundamental analyst gets hard financial data from Alpha Vantage. This includes balance sheets, income statements, and key ratios to evaluate a company's intrinsic value. Second, the technical analysts use Y Finance and Alpha Vantage for marketing data. It looks at price, volume, and technical indicators like MACD and RSI to support trading patterns. Third, the sentiment analyst monitors the crowd. It pulls data from sources like Twitter and Reddit to capture investor emotion and market sentiment. Finally, the news analyst uses the Webs.io dataset to monitor and interpret global events, company-specific news, and macroeconomy trends. Together, these 4 streams give our agent a complete 360-degree view of the market. So, how do these data streams come together? Our system uses 8 agents, which we have organized into 5 distinct layers you see on this slide. It all starts at the top in the analysis layer. Here, 4 specialist agents work in parallel. The fundamental analyst evaluates intrinsic value. The technical analyst detects market trends. The news analyst extracts key events. And the sentiment analyst measures investor mood. Their findings then move on to the research layer. Here, the researcher team does not just average these reports. It synthesizes them and creates a unified research report, debating on both bull and bear cases. Then, in the control and execution layers, the trader agent converts the research into a specific trading plan. The plan is immediately checked by the risk management team, which evaluates our portfolio exposure and ensures risk compliance. Finally, it reaches the decision layer. The portfolio manager agent reviews the complete plan and makes the final call: buy, hold, or sell, logging the entire reasoning chain. This page shows analyst and manager prompts. These two rows represent the foundation of our multi-agent investment reasoning workflow. For the analyst, the base prompt was very straightforward: analyze company fundamentals over the past week. However, the improved version guides the model to go beyond the static reporting by adding expressions like focusing on its overall profile, recent performance trends, and highlight notable shifts compared with previous quarters. The prompts now encourages the model to interpret information, not just list it. It learns to recognize trends, context, and changes over time, while the instruction to summarize findings in a concise markdown table enforces structural and readability. As a result, the output becomes more consistent, more domain relevant, and easier to digest. For the manager, the goal is decision making. The base version simply asked for a summary and buy, sell, hold recommendation. In the improved version, we refined it, demand evidence quality, logical reasoning, and market context. We also added the phrase only if strongly justified to avoid neutral or indecisive answers, and introduced relational and actionable trading plan to make the decision operational. This change encourages a much stronger, more confident recommendation, produces well-supported reasoning, and improves self-correction and consistency over time. On this page, we see the researcher and trader prompts. These agents extend the reasoning pipeline by providing specialized analysis and final execution decisions. For the researcher, we started with a simple instruction: present risks, weaknesses, and refute the bull argument. In the improved prompt, we added structural and precision. Phrases like clear, data-backed, and evidence-based argument, and logical, data-driven reasoning make the tool more analytical and professional. Meanwhile, key risks, structural weaknesses, and negative market indicators burden the context, and maintain a confident, professional, and analytical tone strengthens authority. Together, these edits push the model toward credible, debate-ready reasoning that mirrors a real financial analyst's communication style. Finally, the trader prompt focuses on decision execution. We expanded the analytical scope to include market data, technical trends, and macroeconomy signals. We also directed the model to provide a clear and data-supported recommendation based on both current performance and forward-looking risk assessment. The closing line, apply insights from past trends, brings in a learnable feedback loop, helping the system make more consistent, adaptive trading decisions over time. These refinements make the trader more context-aware, transparent in reasoning, and strategically predictive. Let's move on to results and discussion. To prove our system works, we first need to compare it against common industry benchmarks. We choose 5 baseline models to represent a diverse set of quantitative strategies. These are the passive buy and hold, 2 trade flow models, MACD and simple moving average crossover, an oscillator-based model using KDJ and RSI, and finally, a zero mean reversion strategy. As I just mentioned, our first 2 baselines are the passive buy and hold strategy and the classic MACD trend following model. And here are the remaining 3, the KDJ plus RSI oscillator model, the zero mean reversion strategy, and the simple moving average crossover. We tested our trading agent on 2 representative stocks. One is Google, one is Amazon from August to October. Here we show a big picture of the main experiment result. You can see that the table highlights the comprehensive performance of our trading agent, which consistently outperforms traditional indicators on trading stocks like Google, and remaining resilient and adaptive on more fluctuating stocks like Amazon. The relative improvement of cumulative returns is 30% on Google and about 19% on Amazon, Both are better than baseline trading methods. However, in a certain period, although the trading agent can gain positive cumulative returns, it has negative relevant improvement to baseline models. For example, negative 54, around 55% on Amazon in August. On Amazon, the cumulative return improvement of trading agent over the baseline model is less pronounced than that observed on Google. Let's first look at Google. As you can see here, from the price chart on the left, Google stock has shown a strong upward trend in the past few months. Because of this bullish market, even a simple buy and hold strategy already performs quite well, achieving a cumulative return of nearly 0.49 in October. However, our trading agent still manages to outperform all these baselines consistently, reaching 0.64 in October, with relative improvements over 30% each month. This demonstrates that our model not only follows the general market trend, but also captures additional profitable signals beyond simple holding, as shown in the cumulative return curve, where our trading agent steadily stays above all baseline strategies through the entire period. Then we shall see another stock. Unlike Google, Amazon stock shows larger short-term fluctuations. The trend is less stable, with ups and downs between months. In such violent conditions, purely holding the stock does not always yield steady gains. You can see the original line in the right comparison chart. We can see that while buy and hold performs slightly better in August, our trading agent achieves more consistent positive returns in September and October, especially when other baselines even turn negative. This indicates that our model is robust across different market conditions. It can adapt to both trading and volatile markets, avoiding sharp losses while maintaining long-term profitability. We also conducted an ablation study to understand the contribution of each component with the analyst team of our architecture. Specifically, we removed one of the 4 analysts at a time to see how each affects the overall performance. Each analyst plays a distinct and complementary role. We perform this ablation to evaluate how much each source of information contributes to the agent decision-making process. The results of both Google and Amazon datasets show that the absence of any single module leads to notable performance drop, indicating their individual effectiveness. Notably, the removal of technical analysts consistently results in the most significant degradation across all months and datasets. For instance, on Google in October, performance drops from 0.64 to 0.5. On Amazon in October, from 0.6 to 0.5. This suggests that the technical analyst plays a critical role in the model decision-making process, followed by the sentiment and new analysts. The fundamental analyst, while still contributing, appears to have comparatively less impact in short-term trading performance. This ablation study also indicates that the technical analyst module plays a crucial role within a trading agent, as it is responsible for analyzing stocks using various trading indicators. In contrast, the sentiment analyst and news analyst module appear to be less important than expected. This indirectly suggests that for a specific stock, conducting macro-level analysis of news or market sentiment is less helpful than using technical indicators for trading analysis. Let's move on to the conclusion. In summary, large language model-based trading strategies are generally more advanced than traditional ones. Unlike classical strategies that rely on a single data source or a fixed model, LLM-based systems combine insights from multiple dimensions, such as news, sentiment, and technical indicators, and use several cooperating modules to ensure more reliable decisions. They also don't stick to rigid trading rules. Instead, they can dynamically adjust their logic in response to changing economy or political trends. And finally, while traditional models only react to numerical signals, LLM-based strategies can reason about the story behind the data and even explain their decisions, making the whole trading process more transparent and trustworthy. However, large language models also have their own weaknesses. First, given the same input, they may produce different judgments, which makes their trading strategy hard to reproduce consistently. They also lack of quantitative precision, sometimes misinterpreting numerical indicators or failing to follow strict risk management rules rigorously. Lastly, LLMs rely heavily on their trading data and the way prompts or news are phrased. Differences between words or tunes in analysis and headlines can influence their reasoning and may lead to hallucinations, generating flawed financial logic and poor trading decisions. Okay, thank you for your listening.